Hi, Kai Xiang. Are you there? Hi, Kai Xiang. Or the Poems team. I'll take your cue to start. Okay, I'm guessing that the Poems team has some tech issue. So maybe in the interest of time, let me just go ahead to kickstart this session for the rest of the folks who have joined the call. So first of all, thanks very much for sharing your lunch hour with me. And just by way of introduction, I'm Leonard from the Fidelity Intermediary Distribution team. And I'm quite glad to be here to be able to share with you two of the top investment ideas that we have in the current market juncture, and more importantly also to share with you a brief market outlook in terms of where we see the world headed towards, at least for the remainder of 2024. So the theme for today that we have chosen is really to talk about income investing. And the reason why we have chosen to talk about these as a sort of investment theme for you to sort of look at to build within your portfolio is also because if we take a look at the broader market, we have seen a lot of hot money chasing some of your US stocks, your tech stocks, and of course the latest darling in the market, a name like Nvidia. These have all rallied towards all-time highs. We have also seen a lot of optimism come back into the picture, which is also exactly the reason why we have seen Bitcoin really surge towards the 70 to 75,000 kind of range just in the past week or so, although we have seen that taper off a little bit. But broadly, if we take a look at the market, we have seen quite a lot of optimism being priced in, simply because we are optimistic that inflation will have started to taper down. And also, more importantly, if we take a look at the underlying US economy, it continues to be very, very resilient. But even so, we continue to see some of the risks out there in the horizon, which was also the reason why we still encourage investors to take a sort of income first approach. Look towards high quality bonds as a way for you to hedge away some of these market risks that are still out there. Take this as a chance to also lock in the higher yields that you are seeing in the market. And more importantly, also look towards building some portfolios of dividend stocks just to try to ride some of this growth recovery that we are going to see come out of the Asian region. So maybe just let me go ahead to also give a quick introduction of Fidelity, who we are and also what we do. So Fidelity, we are an asset manager, and we have with us over 50 years of heritage in the asset management industry. And I would say one of the key things that differentiates us from a lot of the other asset managers out there is the fact that we are a private company. So unlike some of the other asset managers where they may be part of a bigger bank, they may be publicly listed, for us, we are a private company, and investment management is the only business that we do within our firm. So we are hyper focused on running investments, and our fundamental objective is really to help our end investors build their wealth over time. And in terms of the overall assets that we are managing today, that stands at over US dollars 700 billion. And I would say another key point to note is that most, if not most, of these assets is going to be invested in active funds. We are an active manager, and bulk of this AUM is going to count towards all these funds that we are actively managing on behalf of our end clients. Last but not least, Fidelity does has a heritage in research. So we have always been known to be very strong in the research part of the investments world. And we bring with us also a network of analysts that are going to be the largest in this side of the world. So this is actually one of the ways that we try to power our investments. This is one of the ways that we go out there into the market to source for some of these investment ideas just by relying on our analysts to go out there, meet with company management, and to give us exactly which are some of the best investment opportunities out there that we can take within our portfolios. So this is Fidelity in a nutshell. And of course, we have been coming off the Oscar season as well. So even within the asset management world, there are a couple of reputable industry awards. And what you can see on this page over here is that we have been the recipient of a number of these industry awards. We have been able to get some recognition for being best in class in managing investments, in delivering very, very strong outcomes across the funds that we are running. So Fidelity, a privately owned asset management company, hyper focused on investments and also one of the leading players in this industry. So maybe let me just go ahead to speak about the market and what are some of our key views as we look ahead to the rest of 2024. So there are a lot of words that you are going to be seeing on this slide over here, but they look to answer one thing, which is our expectations of where the economy and where the market is going to be headed towards for the rest of 2024. So if you recall back in 2023 last year, there were a lot of talk in the market about whether or not we are going to be seeing a recession happen. And of course, in 2023, because of higher inflation, because of higher interest rates, a lot of the market had expectations that we may be seeing some weakening in growth, that we may be seeing some risk off event happen in the market. But of course, flash forward to 2024, we have seen how the economy continues to be surprisingly resilient. We continue to see how the US employment figures continue to be relatively strong. So broadly right now, in terms of what the market is pricing, in terms of the broader expectations, we are seeing a sort of pricing of a soft landing scenario. So this simply means the market does not expect that we will be headed into a recession, simply because if we look at the underlying economic indicators, they still continue to be relatively strong. Unemployment remains relatively low as well. So because of all these expectations of how we are going to be avoiding a recession at the end of the day, we have continued to see the market push towards all-time highs in the US stock market. We have seen tech continue to run away as well. So here at Fidelity, we do sort of think that a soft landing scenario could very well be the way the story plays out in this year. And what this also means for you as investors is that if you are going to be out there in the market to stay invested, continue to be taking risks in the stock market, this is well and fine. You may be able to continue to see positive returns for the rest of this year. But something that we would like to point out is also the fact that if you take a look at the probabilities that we are assigning to each of these market scenarios, recession is still not off the cards. We are still seeing a meaningful probability that a recession may play out. And what this also means is that if you are going to be taking risks, it's very important for you to also start to diversify your portfolios, start to hatch away some of these potential downside risks by going into the fixed income market, by looking at some of your high quality bond funds that are invested in government bonds, in investment grade bonds, simply to lock in some of these yields and to also potentially help to cushion your portfolios if we start to see the market turn south. So if we take a look at some of the key kind of questions that we are seeing in the economy, what we are noticing is that over in the US, we continue to be seeing borrowing costs at all-time highs. So if you thought that in Singapore, mortgage rates are high at about 4% and auto loans are high at between 3 to 4%, if we take a look at the underlying US economy in terms of what households are paying on their mortgages and also in terms of what they're paying in auto loans, these are at multi-decade highs of anywhere between 7 to 9%. So because of this, we have seen how this has translated in surveys in terms of how people are planning to spend. What we are seeing is that there are a lot of consumers who are planning to cut back on their spending for the rest of the year simply because they are feeling the pinch from these higher borrowing costs. And as a result of that, we are seeing how a lot of these surveys are telling us that consumers are planning to cut down on their spending on discretionary items if they can avoid having to spend on some of these things such as entertainment, leisure, eating out. We are starting to see sentiment turn. We are starting to see them plan to cut back on such discretionary spending for the rest of the year. And if we take a look also, while all these economic indicators and news releases that you have been seeing come into the headlines in the US has been surprisingly positive, if we take a look at some of the underlying businesses, for example, in hotels, in restaurants, what we notice is that this demand has started to tick down south. So, for example, the number of hotel bookings have started to sort of soften in the recent times. More importantly, also restaurants, which is a very, very good indicator of just how willing consumers are when it comes to spending. What you'll see also is that when it comes to restaurants, the number of people who are dining out has started to fall steadily. And that is simply because people are finding it a little bit harder to keep up with rising costs. A lot of excess savings that had been built up over the pandemic has also started to be depleted. So one of the reasons why we didn't see a recession sort of play out in 2023 was also because despite higher cost of living, despite higher costs on your mortgages and also borrowings, a lot of households were able to keep up with it simply because during the COVID pandemic, they were building up a lot of excess savings. They were not spending as much. So these excess savings that households were holding on to through the COVID period gave them quite a bit of ammo, quite a bit of cushion to keep up with rising costs. So throughout 2022, 2023, households have actually been tapping on some of these savings to help them ride through the higher cost of living in 2023. But as you can see on this slide over here, what you can see is that these excess savings have been depleted. And that is also one of the reasons why, if we take a look at consumer spending today, some of this sentiment is starting to change simply because households have depleted their excess savings. They are relying on their monthly income right now to meet with their expenses. So this is not just affecting the consumers. Ultimately, if you take a look at the corporate sector in terms of how companies are also behaving right now, we have noticed that companies are focused very much on cost right now. So for example, if we take a look at just how much demand there is from companies to go out there into the market and also try to raise capital to sort of sustain some of their growth, what we can see is that the loan demand in the market has softened quite a bit. Companies are not looking to go out there to take on loans to try to reinvest and build growth. In fact, if you take a look at the headlines of recent days, a lot of the focus right now is on companies restructuring. We have seen news of even a bank like Citi going through a very long period of restructuring and also cutting of costs in the form of employment and retrenchments. So what we can see is that overall, the picture from companies as well is a little bit more cautious. They are focused really more on their bottom line right now, not going out there to raise money, not going out there to borrow money, to try to look towards new growth opportunities. A lot of it is about preparing for tough times ahead. So in terms of unemployment wise, while the unemployment figures coming out of the US has been relatively resilient, what we can see is that these are always just going to be lagging indicators. If we take a look on a forward-looking basis, once a lot of all these retrenchment kind of numbers start feeding into the official data, we expect the unemployment scene to sort of deteriorate a little bit more. So this is also another reason why we think on consumer side, sentiment is starting to weaken. On the companies side as well, they are starting to focus on the bottom line, preparing for tougher times ahead. So now another key question that we get is about inflation and also in terms of interest rates. When do we expect the US central bank to start to cut rates? So in terms of inflation, I think what we can see is that inflation has trended down quite meaningfully. And that is also one of the reasons why we have seen the market start to get a bit more confident that the Fed is just going to be going about cutting rates. And also another reason why markets think that we are past the inflation problem. And so we are starting to see some more interest and sentiment come back into the stock market. So in terms of where the market is pricing the first rate cuts from the US Fed, right now it's starting to look at June 2024. So of course, we have seen the recent kind of a news release that the US Fed is keeping rates steady for now, but all the indications right now are pointing towards the fact that we are done with rate hikes. Right now, it's just going to be a question of when interest rates will start to fall and when the Fed will really start embarking on their rate cut cycle. So right now, market thinks that it will start somewhere in June. We are quite aligned with that thinking also in terms of when we'll start to see the first rate cuts happen. So another key point to sort of share also is the fact that if we take a look in history, every single time the Fed embarks on a rate hike cycle, they have traditionally not been able to achieve the perfect scenario of guiding the economy towards a soft landing. In fact, out of the last 14 rate hike cycles that the US Fed has embarked on since 1950, what we can see is that 11 out of 14 times they were not able to sort of achieve that perfect scenario. In fact, most of this time it resulted in the economy sort of slowing down and entering a sort of recessionary period. So right now, we are seeing the market pricing in extreme optimism that we can achieve that soft landing scenario. But if you look back in history, the odds are against the US Fed. And that is also one of the reasons why we say that right now you should be looking to take some diversification kind of action. Look to bring in some of these high quality bonds into your portfolio if you don't already have them, just to try to cushion some of this downside risk if this perfect scenario does not materialize. And So why is it that we are looking towards high quality kind of bonds as one of the ways to sort of hedge your portfolio from a downside risk? The reason why is simply because if we look back in history, every single time we have a recession and we compare how bonds have performed, specifically US government bonds as one of the examples of the highest quality parts of the bond market. If we just compare how US government bonds have performed versus, say, for example, US equities during such periods of a recession, during such periods when there is a risk off event happening in the market, what you'll notice is that US government bonds typically deliver positive returns of between 4 to 9% during such periods of time. When if you look at the US stock market, you're going to be seeing quite a big drawdown, quite a big negative return, simply because people are panicking and they want to take some risk off the table. And you see a lot of selling action happen within the stock market. So the reason why is simply because during such recessionary periods, one, people are panicking. They want to take risks off the table. They want to just get their money back. So we see a lot of selling happen in the stock market. Two is also because in such recessionary periods, what tends to happen is that your central banks will want to cut interest rates to try to guide the economy back onto a path of growth. And if you think about it, back to your investment 101, how bond prices react when interest rates fall is that when interest rates fall, your bond prices would increase, and that gives you some good capital appreciation potential when such interest rate cuts happen. So this is also one of the reasons why we say that right now, if you want to position your portfolios for falling interest rates and potentially slowing growth and some risk-off event happening in the market, then adding some high quality US government bonds or US investment grade bonds can help to cushion your portfolio, can also potentially help you get some positive returns if this sort of scenario plays out. So in terms of yields as well, I would say that if you take a look right now, in terms of overall bond yields, US 10-year Treasury yields is at about 4.3%. And if we look back in history, the period of 2009 all the way up to this recent rate hike cycle, you would not have been able to get this sort of yield level on some of the safest parts of the fixed income market. And I think that is also one of the reasons why, if you flash back to 2022, at the very first part of this high interest rate kind of environment, what we saw in the Straits Times was a lot of people queuing outside of the banks looking for fixed deposits simply because they could get a yield of about 3% on fixed D when traditionally it was going to be very, very hard to find that sort of yield level. So we have seen a higher interest rate environment play out in this current rate hike cycle since 2022. But if you take a look at where the market is headed towards, if you see how expectations are for the interest rate cuts to start to happen from June onwards, then this window for opportunity is going to be quite limited. And this is also another reason why we say that the timing is really now if you want to really lock in some of these higher yields in today's environment. So if we take a look also in terms of how US government bonds tend to perform in the immediate 1 year after the last rate hike, what you'll notice on this slide is that traditionally US government bonds have been able to deliver between 7 to 9% in the immediate 1 year from the last rate hike of the US Fed. So if you're sort of buying into the view that, okay, we are really truly done with the Fed hiking interest rates, and from here onwards, it's simply going to be a case of when the rate cuts are going to happen, then this is really the time for you to lock it in. And this is also the time for you to add some of these government bonds into your portfolio to try to get some of this upside potential when the rate cuts start to happen. And I would say again, on the right-hand side of this chart, what you can see also is that the odds are really in your favor. The dots will actually represent all the times back in history. If you are going to be buying into US government bonds at current yields, what are the kind of subsequent 5-year returns that you can get? So for example, the black dotted line that you are seeing over here is going to represent the yield level today, which is somewhere around 4.2 to 4.3%. And what you'll notice is that all the blue dots are going to represent the returns of US government bonds in the subsequent 5 years. Every single time in history, bond yields were trading at today's level. So what you can see is one thing, it's really two things rather. The first thing is going to be the fact that if you're buying in at today's level, in history, you would have been able to make positive returns. And two, what you'll notice is that most of these returns are going to be sitting between 3 to 8%. So in terms of making money, in terms of buying into bonds at today's level, specifically US government bonds, in history, the odds are with you. The data is with you. You should be able to make positive returns at current yield levels. So this is really going to tie very well into what the first investment idea that we are going to be showcasing to you today, and that is our Fidelity US Dollar Bond Fund. And why is it that we are showcasing this strategy as a way to sort of play this falling interest rate environment and sort of locking in higher yields? Is simply because if we take a look at what this bond fund tries to do, our portfolio is going to comprise of really two main building blocks. One, US government bonds. Two, US investment grade bonds. So these are simply bonds that are issued by companies, and these are going to be investment grade bonds. So issued by companies that are larger, that are higher quality. So these are the two major building blocks within the portfolio. And it's also why we say that we want to be that sort of unbending quality, that sort of exposure towards the highest quality parts of the fixed income market that can give you good exposure towards the safest bonds that are out there in the market, which is US government bonds, and also the safer bonds that are issued by companies, which are your investment grade bonds. So high yield, which is really going to be the riskier parts of the bond market, within our portfolio, this is a very low allocation. Today, that number stands at around 2%. Emerging market bonds, which you may have heard before, which are also similarly going to be on the higher risk parts of the bond market. This is again a very small part of the portfolio at less than 1%. So the two major building blocks, US government bonds, US investment grade bonds, the focus really is a bias towards quality. The focus is really to give you exposure to the safest parts of the fixed income market. And two, the other kind of outcome that we want to deliver is to make sure we are able to outperform the index. We can give you very good and attractive returns over multiple market cycles. So our current portfolio manager has actually been running this portfolio since 2009. And what we have been able to do is clearly beat the index. In subsequent slides, I'll show you how we have been able to deliver cumulatively since started to run this in 2009. We have been able to beat the index by almost 25 to 27%. More importantly, also, I would say when it comes to investing in the bond market, the biggest risk that you face is about credit risk, or rather default risk. So this is nothing more than just the fear that if you are buying into a bond, the company may default on paying you back the principal and also paying you the interest. So default risk is always one of the largest risks when it comes to investing in the bond market. And I'm happy to share that within our portfolio since 2009, which has gone through and seen through multiple market events, we have had zero defaults within the portfolio. And this is really just a reflection of how we have a very high bias towards the safest parts of the bond market that has allowed us to navigate through all these very volatile periods in the market and really avoiding some of these default events that have been happening in the bond market. And of course, we are backing this with the strength of our research team. So in terms of buying the bonds that are issued by companies, we have a credit analyst to do fundamental research to make sure that we are confident that this company will be able to meet its debt obligations, that these companies are really good quality, that can give us the conviction to invest in their bonds. So research, always one of the resources that we are tapping into to back the kind of investment opportunities that we are finding within this bond fund. And last but not least, even though we are investing within the safest parts of the bond market, for example, US government bonds, US investment grade bonds, it doesn't mean we just simply buy them, hold them, and do nothing. We can be very flexible and dynamic also in terms of managing our exposures across these two building blocks. So if you think about it, even though both are investment grade, high quality bonds, US government bonds is always known to be the safest kind of a bond instrument within the market. And followed by that, of course, when you are investing in investment grade bonds issued by companies, there is a certain level of company risk that comes along with it. So US government bonds are going to be seen as safer and lower risk than investment grade bonds issued by companies. So what we do, even though we are playing in a very, very safe space, what we can do is to very quickly rotate between US government bonds and US investment grade bonds issued by companies. If we want to add risk, we will rotate from US government bonds into these investment grade bonds issued by companies to take on more risk. And if we want to take down risk, if we want to be a bit more defensive, then that is where we will rotate from US investment grade company bonds back into US government bonds. So this is something that we do very, very actively, depending on whether we want to add risk to try to get additional returns for investors or take down risk to try to play a bit of defense. So this is going to be our portfolio management team. So these are going to be the people behind the wheel in terms of running this strategy. So the first guy that you are seeing on the left-hand part of this slide, this is going to be our lead portfolio manager. He is Rick Patel. So he brings with him many years of experience in running bond funds. And today, of course, he is backed up by two core portfolio managers that you're seeing over here on this slide. So Ariel and Daniel. these are going to be two other co-portfolio managers that are helping him in the day-to-day running of the fund, and they bring with them expertise both in trading. So in this case, Daniel used to be from the sell side. He used to be running some of these trades on the trading desk, and Ariel has a background as an analyst. So bringing with them both very different kind of experiences and background, and really helping Rick to manage the portfolios through different market cycles. So I mentioned before, in terms of our underlying portfolio, these are really just the main building blocks. So two main building blocks, US government bonds and of course US investment grade bonds issued by companies, and all the other parts of the more risky parts of the fixed income market, for example, high yield bonds, emerging market bonds, these are going to be a very, very small part of the overall portfolio. So in terms of our allocations, I would say the left-hand side of this chart will show you how we have been managing our allocation across these two building blocks to react and respond to different market conditions. So the blue part, as you can see, is really one of the main parts of the portfolio. That is going to represent our exposure to government bonds. The yellow part is going to represent our exposure to investment grade bonds. And what you'll notice is that in the year of 2020, which is the COVID period, what you can see is that we were actively able to rotate from government bonds into investment grade bonds. Why did we do so? Is simply because if you flash back to COVID period, when the pandemic broke out, what we saw was a lot of panic selling happening in the market. So even though there are bonds that are issued by really some of your national champion banks like Citi in US, Wells Fargo, and even a name like JP Morgan, even though these are all systemically important banks, these are really your largest kind of high quality banks out there in the US, the market was also selling out some of these bonds simply because everyone was panicking and they wanted to take risk off the table. So that gave us a chance to buy into some of these investment grade bonds at cheaper prices. So this was something that we did. And throughout the second half of 2020, when we saw how there was a very good recovery happen in the market, and we saw quite a bit of risk taking happen also after the Fed started to cut rates, this allowed us to take some profit. And what we actually did was we were sitting on good profit from all these bonds that we had bought at a discount. We started to take some profit on these company bonds and rotate back into government bonds just to play a little bit of defense, just to be a little bit more wary of the overall price of the market. So this is something that we can do very, very actively. And if you look at how we are positioned today, what you'll notice is that our government bond exposure is still going to be the largest part of the portfolio. Today, that sits at around 56%. We are conscious that if we look at the broader market today, things look a little bit expensive. Everything looks to be a little bit too optimistic. So this is one of the reasons why we are being a little bit more cautious. We prefer to lock in yields within the safest parts of the market, which is US government bonds. And then we have about 37 to 40% of the portfolio invested in investment grade bonds. And like I mentioned, what you'll see is that our high yield exposure, very, very low at around 2%, emerging market debt, just barely 50 basis points within the portfolio. So credit rating wise, what you can see again, very much high in quality. Right now it's sitting at about single A to double A minus. And if you take a look in history, we have not been hugging the line at triple B. So if we take a look at the cutoff rating before a bond starts to be considered high yield, for a bond to be considered high yield, it's going to be occupying the part of the credit ladder below triple B. So anything above triple B, that is going to be considered investment grade. And what you can see is that for us, we are not even going to be playing in that space. Our overall credit rating is always within the A range, which is on the higher quality parts of the credit ladder. So in terms of our performance of the fund as well, what you can see in the blue dot, this is going to represent how our fund has performed, both in terms of returns and also volatility. And what you can see is that we are sitting on the left-hand part of the chart, which also means that in terms of volatility versus the dot in orange is going to represent the global bond index, and the part in yellow is going to represent high yield bonds. What you can see is that we are sitting on the left-hand part, which means we are less volatile than both the global bond market and also the high yield bond market. And in terms of returns as well, what you can see is that we are sitting higher than the global bond index. And that also just means we have been able to deliver higher returns with lower volatility compared to if you are just going to be buying into the broader bond market. And on the right-hand side, what you can see is that gross of fees, we have been able to outperform the index over the last 10 calendar years. And this is simply down to the fact that we have had a very good track record in terms of choosing some of these investment grade bonds that have been able to do well. And more importantly, also our asset allocation being able to respond to different market conditions. We have been able to deliver some alpha from there as well. So back to the track record of the fund, what you can see is that since '09, which is when our portfolio manager has been running it, our fund in blue, we have been able to outperform the index in orange by 27%, which is not a small feat at all. We have been able to deliver alpha through our credit selection, through our asset allocation also between government bonds and also US investment grade bonds. So in terms of asset allocation wise, I mentioned about this, but again, our portfolio right now is anchored on US government bonds at around 57%, investment grade bonds at around 37%. What you can see is a pretty balanced split between bonds that we are investing in, issued by financial companies, and also from other sectors, for example, your healthcare sectors, your utility sectors. These are also some of the opportunities that we can take within the investment grade space. So in terms of some key portfolio characteristics as well, so duration is going to be a concept, it's going to be a number that will reflect how sensitive the bond price is to changes in interest rates. So what this simply means is that if you have a bond fund with a higher duration number, this would mean that the bond price is expected to shift more in line with a change in interest rates. So if we take a look today, if we sort of see the expectation that from here onwards is going to be a falling rate environment, then what you want to do is to sort of position yourselves for bond funds that have a slightly longer duration number, because that also means that the bond prices will be expected to appreciate more with a change, with a fall in interest rates. So today, the duration of our portfolio sits at around 7 years. And if you compare us to some of the common peers out there in the market, which tend to sit at between 3 to 5 years in duration, this also means that in a falling rate environment, when bond yields and also interest rates start to move down, we should expect to capture more of that capital appreciation with falling interest rates. So this is our duration statistic. And of course, the overall yield of the portfolio today sits at around 4.3%. And if we take a look at the payout also, so end of the day, investors who are looking at bond funds are going to be asking about the income stream that they can expect to get from the investment. So we do offer two different share classes, so two different options for investors to look at. The first is a M income share class, and this is a share class that pays out about 4.5%. The second is a higher payout share class, really to address some of the investors who want to sort of see a higher income payout month on month. So this is our MCDIS share class that pays out around 6%. And both options are available on the Phillip platform for you to tap into, depending on whether you are chasing for a higher income or you are going to be looking for just a natural kind of income payout of 4.5% and see a little bit more capital appreciation over time. So in terms of overall AUM of the fund, today that sits at around 3.3 billion. So definitely not a new kid on the block. And I would say again, this has a very long track record. We have been running this since 1990s, and the current portfolio manager has been running this since 2009. So again, a lot of continuity and a very, very strong track record that should give you confidence when looking at this fund. So maybe let me just quickly move towards the second investment idea, and I hope to also leave about 10 minutes to address any questions that any of you on the call may have about the market or about some of the investment ideas that we are showcasing. So now switching lens a little bit more, I just spoke about US government bonds and also US investment grade bonds in the form of our Fidelity US Dollar Bond Fund as the first investment idea. Now we are going to take it back closer to home. We are going to be looking at the Asia Pacific region, and we are also going to be switching asset class to look at equities as one of the investment ideas today. So that is going to be our Fidelity Asia Pacific Dividend Fund. And why we think Asia is going to be something that's interesting to look at the current market juncture is simply because if you think back to what I was speaking about in the first 5 minutes of this call, in terms of the broader outlook in the economy, we are seeing US, Europe, developed markets coming off a pretty high base. Things have been looking very rosy, things have been looking very optimistic. But if we look ahead, we are seeing signs of a slowdown. In Asia, on the other hand, we have actually been coming off a pretty weak market since 2021. And a large part of it is also because China has been going through some very tough challenges. And China has always been a very big engine of growth for the Asian region. So while the US markets have been going up since 2021, if you take a look at the Asian region, if you take a look at even a giant like China, the market conditions have actually been telling a completely different story. The stock market in Asia Pacific has actually weakened quite a bit since the highs of 2021. And if we look ahead, it's going to be a story of recovery rather than a story of slowdown that you're seeing in the US. In fact, if we take a look at growth forecasts, we do expect the growth in the Asian region to be well ahead of the developed markets such as US, Europe. So I would say this is again one of the reasons why we think that if you want to position yourself for growth within the stock market, Asia Pacific stocks can actually be one of the ways to try to capture some of this recovery story, especially if you are already sitting on some very, very good profit from US equities. So it's going to also come down to the style that you want to take. Should we be looking at growth stocks in Asia Pacific, or should we be focusing on stocks that pay a dividend? So what we can see in Asia is that it's quite a different story from the US, where growth stocks have really been leading quite a bit of the rally. In Asia, actually, if we look back in history, what we can see is that dividend stocks have actually outperformed the broader Asian market. So that's going to be the line in orange, which is going to represent a basket of dividend stocks right here in Asia. And we have compared that against the broader Asia stock market index, which is measured in the blue, reflected in the blue line over here. And on the right hand side, what you can see also is that investing in dividend stocks have also been able to give you that sort of downside protection in past instances where we have seen very big risk off happen within the market. So you are not going to be compromising on returns over time just by taking a dividend approach. In fact, we have been able to see how dividend stocks have outperformed, have been able to give higher returns, and they have also been able to give very good defensive kind of qualities when markets are drawing down. So if you take a look also at the end of the day, Asian stocks also pay a higher dividend relative to their peers in the US, where they tend to prefer share buybacks. So if you want to be looking for income opportunities right here in Asia Pacific, then that gives you a very good universe of opportunities compared to if you're going to be looking to get some of these dividend kind of opportunities out of the developed markets such as US and also the broader world average. So we have continued to also see how Asian stocks have also been able to grow their dividend over time. So this is again something that I wanted to take the chance to share also. Ultimately, if you are going to be looking to invest in dividend stocks, don't just focus on the dividend yield, which is represented as a percentage. Also consider the dollar amount that you are getting from your investment in these dividend stocks. Simply because if you think about it, the dividend yield percentage number, this is also going to reflect the dividend yield as a percentage of the share price. So for example, if you are invested in a stock that is maintaining the dividend, but their share price has been going down, their dividend yield would be optically looking to be higher. So at the end of the day also, if you are invested in dividend stocks, you want to see the dollar amount that you are actually getting from your investment grow over time. And what we notice is that in Asia, companies have been able to grow their dividend distribution over time. And so the dollar amount that is credited into your bank account from your investment would have actually been able to grow at a more sustainable rate compared to if you're invested in other parts of the world for dividends. Broadly also, if you take a look at the entry point today in terms of whether or not Asian stocks look expensive relative to history, what you can see is that since 2004, if we take a look at just how expensive Asian stocks are today, we are well below the long-term average, which also means this is going to be, again, a pretty good entry time for you to look at allocating some of your investments, some of your portfolio towards Asian stocks, because the price that you are buying into today is relatively attractive. You're not going to be buying in at close to all-time high valuations. And more importantly also, what we see is that Asian stocks today are trading on quite a big discount relative to global equities. So this also means that relative to the rest of the world, Asian stocks today are trading at quite a good discount of around 25 to 30%. So they do give you that sort of valuation support. In terms of your entry point, you can be quite confident that you are not buying close to an all-time high when it comes to Asia Pacific stocks. So how do we translate all of that? How are we going to position our Asia Pacific dividend fund in the current market environment? Right now, of course, we are going to be focusing really on dividend opportunities. We want to make sure that the companies we are investing in give us a very attractive dividend potential. So today, the underlying yield of the portfolio sits at between 4.2 to 4.5%. And what we are paying out to investors is close to that 4.5% kind of range. And I will say again, the main focus is on making sure that we don't just focus on the percentage amount. We also want to make sure that the dollar amount that we are paying out will also increase year on year. And we have been able to grow that since 2021. The dollar amount that we have distributed has increased since 2021. In terms of the investment style also, we are focusing on good quality companies. So really going to be looking at companies with strong balance sheets, companies with very healthy cash flows, making sure that these are quality companies that we are bringing into the portfolio. And also, of course, we want to make sure that we are buying into them at reasonable valuations. And this also means we are not chasing for stocks at all costs. We will only buy into a stock if we are confident that the valuations that we are buying into is reasonable or otherwise undervalued. And this helps us do two things. One, it helps us improve our return potential because it means we are not going to be buying in to stocks at their all-time highs. Two, if things are to turn south and we sort of see a risk-off event happen in the market, because we didn't buy into these stocks at expensive valuations, it also means our exposure to downside will be less compared to if we were chasing for growth at all costs. And last but not least, of course, is going to be the fact that we are backing this up with research. Every single one of the portfolio companies that we are invested in will be covered by a research analyst. And this is something that will give us again the conviction that the ideas that we are buying into, we are confident they should be able to do well for us in the longer term. So this is going to be the portfolio manager behind this strategy. So his name is Jochen, and he runs this strategy right here out of Singapore. He has been running this strategy since 2021, and he has always had a philosophy of dividend investing. So his focus has always been about identifying some of the best quality companies that are paying out a sustainable to growing level of dividend over time. That has always been his philosophy. That has always been his strength. So in terms of his philosophy, he likes to say that it's as easy as just thinking about looking for companies that meet this ABC criteria. So before investing, we want to make sure that a company ticks all these boxes. We want to be sure that this stock is trading at attractive valuations, that they are better quality, and also that they pay a consistent to growing level of dividend over time. These are some of the three qualities that we look for in a stock before we start bringing it into our portfolio. And if we take a look at how that is translated into returns, I would say a very key kind of a test of this strategy would have been the sell-off in the equity markets in 2022. So if we recall, 2022 was a very bad time to be invested in the market because of high interest rates, because of inflation fears, and also because of all the geopolitical kind of tensions that were happening. China, of course, was also getting started with their crackdown in the various sectors like technology, like property. So that was actually a very tough year for the Asian stock markets in general. So we saw how the broader Asian stock market closed the year down about minus 17%. So because of our fund's quality bias, because of our focus on dividend stocks, that gave us quite good downside protection. We were able to cushion about 1/3 of the downside. We closed the year at about minus 10%. And ultimately also, it's not just simply about making sure we lose less money. When the markets are rallying, when markets are also making money for investors, we want to make sure we participate in the upside. We want to make sure that we are growing our investment value as well. So in the year of 2023, where we saw a bit of a recovery happen in Asia, led by names like Indonesia, led by Japan as another example, and also, of course, India was one of the huge growth stories of 2023. The market closed the year at up about 7.7%. We were able to capture quite a decent amount of this upside. We closed the year at about 6.6%. So ultimately, what are some of the outcomes that we can expect? When markets are rallying, we want to be able to keep up with it. And more importantly, also when markets are selling down very hard, we want to make sure we give you a very good cushion. We want to make sure that we give you some downside protection. So if you take a look at how the fund has performed since our portfolio manager started to take over in 2021, we have been able to deliver annualized returns of around 4%. And versus the broader Asian market, Asian markets have been going through a pretty tough time, as I mentioned. Asian markets, on an annualized basis, is down about minus 1.2%. We have been able to outperform by almost 4% on an annualized basis since 2021. So how we have been able to do that is simply because, like I mentioned, our philosophy, we tend to be a little bit more defensive by focusing on higher quality companies that are a bit more stable, that are a bit more resilient. So if you take a look at what we are invested in, around 2/3 of the portfolio, so today it's about 61%, we are invested in defensive sectors. So these are going to be sectors that are less sensitive to the broader economy. So you are going to be seeing less exposure towards very volatile parts of the market like technology, like some of your banks. What you're going to be seeing is more exposure towards, say, for example, utilities, your exchanges, your insurance companies, and also your consumer staples, which are companies that are selling some of your household supermarket goods. So what we do not have exposure within the fund, we don't have exposure to China banks. Why? Is simply because in China, we do see how Chinese banks are still one of the ways that the Chinese government will operate some of their state policies. So a little bit of that national service kind of a concept in play within China banks. So because we can't control that, we would want to just simply take the risk out of the portfolio. Today, we do not have any exposure towards China banks. We also don't have any exposure towards China internet simply because they tend to pay a lower dividend. And also in terms of valuations, they tend to be trading at slightly more expensive valuations relative to the rest of the other sectors. We also, of course, don't hold any stock that don't pay a dividend. We want to make sure that we are true to our philosophy of being a dividend fund. So in general, the stocks that we hold within the portfolio would have to pay a dividend before we start to look at bringing it inside the portfolio. So healthcare is also another area that we are not invested in, simply because if you take a look in the Asian region, healthcare is also subject to a lot of regulatory intervention, a lot of control from the government in terms of controlling what are some of the prices of the medicine that these healthcare companies are selling at. So again, healthcare companies are a bit subject to these kind of regulatory actions. They can't control their profit margins as much because these are all subject to government approvals. So again, an area that we simply avoid simply because this is going to be giving some exposure to regulatory risks. So end of the day, we are going to be favoring the more defensive parts of the market. We want to be focusing more on stability across different market cycles. So in terms of sector allocations, what are some of the ways that we can play? Within the financial space, we don't want to be chasing for banks because these tend to be more sensitive to the broader economy. Where we are going to be looking for, we are going to be looking for some of your insurance companies because they tend to earn a more steady revenue. We are going to be looking for stock exchanges as well, because if you think about it, during sort of a more volatile market periods, what you tend to see happen is more trading activity in the market. So stock exchanges can actually benefit from a volatile period of the market. We also want to be looking at consumer staples, so companies that are involved in household goods, simply because even though markets may be going through a slowdown in growth, we may be seeing sort of a recessionary concern come into the picture. End of the day, household goods still see a relatively steady demand. So this is an area that we prefer to have within the portfolio, a little bit more stable in terms of their revenues and also their cash flows. So we look for some of these very strong kind of consumer staples companies like Thai Beverage, Uni-President, and also a name like Kao. So that's going to be a Japanese company that owns some of the very common household brands that you're going to be seeing in the supermarket like Magiclean. So IT sector, we are being very, very selective. We want to make sure that the kind of names that we are buying into, we are not going to be chasing for them at expensive valuations. So today, the selectiveness of it leads us to a few top names like Infosys, which is a name of India, which provides a lot of IT outsourcing services to the rest of the market. Samsung Electronics, TSMC, again, these are two very good companies that give us a pretty good runway for growth. Real estate also, ultimately, we do see a lot of opportunities within REITs. So within REITs, that's where we have a name like Embassy Office Parks. This is an Indian office REITs. And we also own an Australia REIT that's called HomeCo Daily Needs. This REIT actually specializes in leasing out space to some of your kind of consumer staples like supermarkets, some of your clinics as well. So these are some of the ways that we can play the real estate market as well. So in terms of overall country exposure, we are going to be pretty balanced, even though China and India are two huge giants in the Asia Pacific markets. And if you look at some of our peers out there in the market, just looking at their China and India exposure, it's going to be close to half of the portfolio. Within our portfolio, we would want to be a little bit more balanced. And that is why at our China exposure today, that sits at around 16%, India at around 8%. If we sum them up, it's just going to be about a quarter of the portfolio, a lot more diversified, a lot more balanced than our peers that are running an exposure of almost half. And we also find some very good opportunities in Australia, simply because if you look at the Australian market, they do have a lot of mature companies that are very, very strong in what they do as well. For example, Treasury Wine Estate, they own the sort of brands such as Penfolds, 19 Crimes. These are going to be some of your very leading kind of wine labels that a name like Treasury Wine Estate in Australia, are owning. And of course, also they do have some of your very strong telcos. For example, a name like Telstra, again, is going to be one of the leaders in the Australian market in telecommunications that we likewise hold within the portfolio. So if we take a look at some of our top 10 holdings, again, these are going to be some of the names that you are going to be very, very familiar with. We are not going to be hedging, we are not going to be having some of these bets within the more speculative parts of the Asia Pacific markets. So you are going to be seeing names like TSMC, Samsung, very strong franchises. We are also going to be seeing some of your insurance names as well. So Samsung Fire and Marine Insurance, one of the larger ones out in Korea. And also, of course, within the insurance names, we have a name like AIA as well. Singapore Exchange, not going to be something that's alien to you. So top 10 holdings wise, what you can see, very, very selective, very, very, very balanced. And also in terms of the kind of companies that we are going for, these tend to be very leading players in their respective sectors. So today, our portfolio is diversified across 43 different stock holdings. And of course, overall, the dividend yield of the fund sits at around 4.3 to 4.5%. And that is exactly the income that we are paying out to investors. And the fund is also available on the Phillip platform for you to tap on. So maybe with that, I would say that wraps up what we have prepared for you today in terms of the two top investment ideas that we have for you. The first is going to be Fidelity US Dollar Bond Fund that really gives you exposure towards the highest quality parts of the bond market, US government bonds, and also US investment grade bonds. And this is going to be something that you can look to hedge out some of the risks if a slowdown, if a recession is going to be starting to come into the picture. The second one is going to be Asia Pacific Dividend, and that is going to be a portfolio that looks towards dividend stocks in Asia Pacific that are higher quality, that pay a consistent growing level of dividend, and gives a pretty attractive dividend yield of around 4.5% right now. So maybe with that, let me just move on to the Q&A because I do see a number of questions coming out over here. So the first question would be something that I think should be quite quick to answer. So the question is about whether no defaults means low returns. So I would say in terms of the investments world, one of the fundamental kind of saying is that low risk, low return, higher risk, high returns. But I would say at the end of the day also, when we are invested within the bond market, default risk is a very, very important thing for you to consider simply because if you think about it, when you buy a bond today, if a bond defaults, it also means that whatever you are invested in, you are not going to be getting any money back. You may be able to recover. There would be some recovery value of maybe 10 cents to a dollar, but the majority part of your capital would be wiped out whenever there is a default happening for a bond. So in terms of navigating the bond market, I would say default risk is going to be a very, very big consideration for you. So no defaults actually is something that you can take comfort in because if we are able to avoid defaults, it also means we are able to avoid some of the biggest downside risks that can drag your portfolio down. So that's also one of the reasons why if you take a look at our fund and how it has performed versus the global bond index, we have been able to deliver higher returns with lower volatility simply because we are very active, we are being very, very selective, and that has allowed us to avoid some of these defaults that have happened in the bond market that has cost investors quite a bit of their capital. The second question I think is quite interesting, which is about how investment grade bond funds seem to be performing relatively worse than high yield bonds. So one of the reasons why is also because if you think about it in the market, 2023 was a year when there was quite a bit of risk taking happening. And in fact, even until today, like I mentioned, the markets are pricing in a lot of optimism because they think we are done with the inflation problem. And they are also sort of having the view that underlying economy looks to be pretty strong, so they are comfortable to take on more risk. So high yield bonds have actually been able to sort of benefit from that kind of risk taking activity, which is why they have actually been able to deliver better returns than the safer parts of the bond market simply because of optimism, simply because there has been quite a bit of risk-taking activity happening in the market. And also another thing to point out is that within the safer parts of the market, they tend to have a higher duration number, which simply means investment grade bonds, government bonds, they tend to be more sensitive to changes in interest rates compared to your high yield bonds, which tend to have a shorter duration. So if we sort of look at the opportunity today in the market, I would say the first thing is in terms of the broader economy, we are seeing signs of a slowdown. And it also looks like if we look ahead to the rest of the year, a growth slowdown is quite likely. And two, it will be a rate cut kind of environment. So this is where you want to look for bonds with a higher duration number because their bond prices will appreciate more with changes with the fall in interest rates compared to bond funds with a shorter duration profile. So I would say if we look ahead, if we lock it in today in terms of high quality bonds, US government bonds, US investment grade bonds, that will position you very well in terms of falling interest rates to be able to benefit the most from the bond price appreciation that will happen when the interest rates start to fall. So that's another to sort of emphasize. So maybe the other kind of questions would be in relation to the Asia Pacific Dividend Fund. So the question is, why no exposure to Australia banks? That's also because if we take a look at the Australia market, Australia banks tend to be a lot more mature. In a way, they are seen almost as a very highly developed kind of a part of the financial market. So as a result of that, Australia banks tend to trade at more expensive valuations compared to, say, for example, a bank in India or a bank in the rest of Asia, like Indonesia. So because of this, because Australia banks tend to be viewed almost like a developed market kind of bank compared to, say, for example, an Indonesian bank, this also means that if you are buying into Australia banks today, you are going to be buying in at more expensive valuations compared to if you are taking an opportunity out of an Indonesia bank. So this is one of the reasons why we're avoiding Australia banks for now. It's simply because if you take a look at the valuations that they're trading at today, we think that they are a little bit expensive. We can find better opportunities in the rest of the Asia Pacific region. So another reason why we don't invest in banks as much is also because if you take a look at the financial market, there's going to be two major parts of it. The first is going to be your traditional banks. The second one are going to be your insurance companies. These are two of the larger parts of the financial sector. So why we tend to have a sort of underweight to banks is also because banks tend to be very, very sensitive to the broader economy. So that also means that they go up and down pretty much in line with the broader economy. So this also means that they are going to be a little bit of a roller coaster ride if your investors are going to be looking at investing in banks. So this is one of the reasons why we prefer insurance companies, because if you think about it, especially in the fire and property insurance kind of space, what these insurance companies are getting in terms of their revenue is insurance premiums, and these tend to be more sticky. They tend to be a little bit more stable compared to banks, which are making their money really from loans and from also the net interest margin, which will change and fluctuate depending on the interest rate environment. So why we avoid banks, or rather why we are underweight banks and why we prefer insurance, is simply because insurance companies are a little bit more stable in their revenues, a little bit more resilient also through different market cycles, but banks tend to go up and down quite a bit in line with the broader economy. So the second question is about how Fidelity Global Dividend Fund compares to Fidelity Asia Pacific Dividend Fund. So the difference is really down as the name suggests, Fidelity Global Dividend is really a global kind of portfolio, which also means we are we are investing in companies out of US, Europe. We are not just limited to the Asia Pacific region, such as our Asia Pacific Dividend Fund. So I would say today the reason why we are profiling Asia Pacific dividend is simply because back down to our sort of expectations of the broader economy, we do think that the developed markets, US, Europe, are coming off a very high base. They are going to be seeing some signs of a slowdown. But Asia Pacific region, we are still in the early stages of the recovery. If anything, we are coming off a pretty much a bear market cycle starting since 2021. And this recovery story is something that looks relatively more attractive compared to if you're going to be looking for opportunities in US and Europe, where US, as an example, you're coming off the S&P at close to all-time highs. So that is also one of the reasons why we would say that look at Asia Pacific region right now as one of the ways for you to sort of take risks in the stock markets, simply because valuations look more attractive compared to the US and Europe, where they are coming off a very, very high base. But in terms of the underlying philosophy between global dividend and also Asia Pacific dividend, it is similar in the way that they both look for companies that pay a dividend. They have a quality bias as well in terms of the companies that they look for. And last but not least, both are very, very strong in terms of their valuation discipline. They will not overpay and chase for stocks at all costs. So these are going to be some of the key points to sort of share. So the last kind of a question before I guess we close the session is going to be about how we compare against multi-sector bond funds. For example, funds that can rotate into high-yield bonds, emerging market bonds, and even mortgage-backed securities. So I would say that compared to some of the kind of common bond funds out there in the market that you would tend to hear. So what you'll notice is that some of these other bonds, if you take a look at what they are invested in, you may see high yield bond exposure of between 6 to 20%. You are going to be seeing mortgage-backed securities as well in the portfolio, anywhere between 25 to 50%. So within our fund, I would say that our focus has always been on the higher quality parts of the market. We just want to be focusing on US government bonds and also US investment grade bonds as two largest building blocks. Why is simply because if we take a look at the high yield bond market, that is an area of risk that we see. We are comfortable to go up to maybe 10%, but right now we are just purely focused on keeping that number low because things look a lot more expensive. Things look a lot more optimistic than what we compare in terms of our outlook in the year ahead. So multi-sector bond funds, ultimately, they may have some sort of a more meaningful exposure towards the riskier parts of the bond market. That is an area that is not going to be an area of focus within our US dollar bond fund. So I think ultimately it's going to come down to what you're trying to position yourself for and what is the kind of outcomes that you're trying to build within your portfolio. Multi-sector bond funds, by virtue of the fact that they have more meaningful exposure towards the high yield parts of the bond market, if things are going to turn south because they're invested in the more risky parts of the market, this will give them more exposure towards the downside. Whereas for ours, if you are sort of going to position for yourself potentially slowing growth in the market and also of course falling interest rate environment, then our bond fund that has that focus on the highest quality parts of the bond market, that should help you to cushion more of this risk off event. That should also help you make more potentially on the upside when these interest rate cuts start to fall, simply because we have a higher duration number than some of these multi-sector bond funds. Okay, so I think thanks very much for those questions. I hope I have been able to address most of them well. And otherwise, if you have any kind of questions, do feel free to reach out to your Philip advisor. They know how to reach me. And otherwise, I would say in the year ahead, I would like to wish all of you all a very hot and good year of the dragon ahead. And hope to also take the chance to share more about the rest of our Fidelity strategies in the months to come as well. So maybe with this, let me just end the session here and see whether Kai Xiang or the Poems team have any closing words to say. Okay, otherwise, with that, thanks very much once again for sharing your lunch hour and see you guys again.